Okay, thanks to everyone for logging into the Partners Group webinar on the required employer reporting under the Affordable Care Act and Variable Hour Employee Update. My name is Mark Rose. I'm a consultant and partner with the Partners Group, and I'm also the Director of Health Plan Compliance and Reform. So, as I said a couple of minutes ago, for the purposes of this webinar, we're going to have all of the attendee phones are going to be muted, simply because we expect to have 50 or more participants, so we won't have the crosstalk. You do have the ability to send in questions. We'll do our best to answer some, if not all of those, at the end of the webinar. But as we're trying to keep this to 45 minutes, there's a good chance we won't be able to address all the questions, in which case everyone who is logged in to participate in the webinar will receive a complete slide deck along with questions and answers, all questions that were submitted with answers. So as we begin the webinar, to jump right in, we're going to cover really four things today. We're going to cover the federal health care reform required employer reporting under IRS Code 6056, and that includes two different sections. That's the individual employee statements that have to be sent to every full-time employee of all applicable large employers. That's employees working 30 more hours a week, as well as the employer filing of 6056 to the IRS, or 1094-C. We're going to talk about determining measurement strategies for all employees, and there are two different strategies we're going to go through, which the IRS allows us to be able to use either a monthly measurement period or the look-back method for variable hours. That's the method where we can go back and look back up to a year to measure people to make sure they average. And for school districts, this is really going to be pertinent to all of your variable hour employees, but really specifically, we're going to be looking at substitute teachers and how it applies to them. Next, we're going to look at tracking of variable hour employees, so offering employees coverage to those employees who average 30 hours a week. And then lastly, we're going to talk a little bit about the Washington Health Benefit Exchange letter that many of you have already received for some of your employees that have applied for and been determined to be eligible for subsidies through the exchange. And there's been a lot of misunderstandings about this letter and what that means, and then also what your options are and how you might want to respond or not respond to that letter if you receive one of those. So diving right in, the required section 6056 reporting. So under the IRS Code 6056, applicable large employers, and that's employers with 50 or more full-time employee equivalents. And so looking at all of those who registered for the seminar, I can safely say that every single school district that is registered to participate in this is associated with a large employer as a school district. So there were no school districts signed up for this webinar or that have logged in that are not applicable large employers. So we're not going to spend time talking about how you determine whether or not you're a large employer. For the purposes of this webinar, all that are on this call are large employers. So there are two different sides to the reporting. The first one is 1095-C, statements to employees. And there's been a little bit of confusion about the due date on this. And so we had a seminar that many of you probably signed into on employer reporting a couple weeks ago where we partnered with ADP payroll systems. So the individual statements, this has to be provided by January 31st of 2016 to all ACA full-time employees who work 30 hours per week in one or more months of 2015. So this is actually due on the same timeline as your W-2s are going to be due. So this is not the same as the March 31st or February 28th deadline for the 1094-C and 1095-C employer filing that's due to the IRS. So these are individual employee statements that have to be sent out to, once again, any employee, including variable hour employees that work more than 130 hours in any month. So another thing that I think is misunderstood about this is if you're using the look-back method, which we'll talk about in a little bit, even employees that are currently being measured and are not eligible for benefits are required to be sent a notice if they work more than 130 hours in any one month during the calendar year. So the last piece of this that I think some employers kind of get a little bit sideways on is what the transition relief means. So many of you have transition relief if you have a group health plan that did not change its effective date from October to November last year. Specifically, I know group health cooperative plans, for the most part, we kept those for our clients to have that October 1st date that gives transition relief from possible penalties until October 1st of 2015. Even if you have transition relief, you still have to report on those months during 2015 prior to that relief. So for January through September, you still have to provide the reporting. So the 1094-C and 95-C employer filing to the IRS, these returns have to be provided by February 28, 2016 if you're filing by paper, or March 31st if you're filing electronically. So hopefully everyone will be filing electronically and you'll have that extra month. So you'll have 3 months into 2016. Thing I want to stress here, and we'll talk about this more in a little bit, is the forms that we're going to look at, they're drafts. So they're not finalized by the IRS yet. We still have 13 months before they're actually going to be due. So there will be some changes. So we don't have final forms or final information yet on how this will have to be filed. So next, if we look at the data to be remitted, this is what actually has to be reported. So the reporting has to include any employee who is ACA full-time for 1 month in the calendar year. So if you have a substitute teacher, for example, that has 1 month where they have 140 hours in every other month of the year, they are below that. They'll need to be included in that and have to get a statement. So that's, once again, any employee that works for the district more than 130 hours in any calendar month during the year. So the one thing that I think is going to be a surprise to a lot of the employers, especially with school districts as they look at it, is the employees that you're not required to report. So if you have employees that do not breach that 130-hour benchmark at any point throughout the calendar year, so if they're a 0.7, or if they're a half-time PSC, paraeducator, or custodian, or bus driver, even if they're enrolled in the benefits for the entire 12 months, they do not have to be included in this report. So once again, regardless of whether or not they are on the medical plan, if they don't breach 130 hours in any calendar month, even if they're enrolled in the benefits, you don't have to report on them. So most school districts are going to need to use the general method for reporting. And so that's going to require that you submit basic employer information. That's going to be address, tax ID number for the employer, those type of things. Certification as to whether the employer provided minimum essential coverage to full-time employees and their dependents on a monthly breakout. Month's minimum essential coverage was available to each full-time employee. Each full-time employee's monthly cost for employee-only coverage under the employer's least expensive minimum value plan. So just as a side note, if you're a TPG client, I can say this with certainty, and I believe for all of the Primera Blue Cross plans, as well as I haven't really found a school district plan in the state of Washington that doesn't meet minimum essential coverage, but I know that the minimum value test is passed by every client of the partners groups that has a group health, Primera, Regents, Aetna, or MOTA health plan. Those all meet that minimum value. So the lowest cost option would definitely be minimum value, and that would include even the HSA option is minimum value. So the number of full-time employees employed each month in the calendar year, name, address, and tax ID number of each full-time employee employed during the calendar year, and the months each employee was covered on the group health plan during the calendar year. So all school district plans, one thing that we get a lot of immediate question, and I think probably raises anxiety for everyone when they look at this data, is how do we pull this data? So I will say that the Northwest Regional Data Center, NWRDC, which supports probably the majority of the districts on this call, or the other with SIPSI or alternative payroll system that is being used by a district, is working on reports that will provide this data to you via a crystal reporting target. They've told us their target date for release of the report is mid-April. That was about 3 weeks ago when we spoke with the folks at NWRDC. I believe that's still the date, but just to be clear, this is something that they're working on being able to pull from your payroll system to be able to provide to you. So it's not something that right now we would be able to help you actually pull that data. That's something along with the data as far as the variable hour tracking that would be able to be pulled through the payroll support system. So 1094C. So this is a copy, and I want to pay close attention to the watermark at the top, which is a draft. So, and also don't file. But we just want to be clear that this is not finalized. But if we do take a look at what's going to be included on this, you'll see that there's the top section, which is Section 1, which is going to be the employer's general information. Part 2, which is going to be the ALE, which stands for Applicable Large Employer Member Information. And if you look at Section 22, which is certification of eligibility, so you've got the 4 different sections: qualifying offer method with transitional relief, Section 4980, that's the penalty section of the law, transition relief, and 98% offer method. This is something that we're going to be providing support on when it comes time to actually filling these out, as far as whether or not your district has transition relief. As I mentioned earlier, if you do have a plan that did not renew or move its renewal date off of that October 1st date this past year, you would have transition relief. But we're going to be providing support on how to fill out this section of the form for our clients. So if we look at the next section, which is Part 3, you're going to see they're different. They're going to want this reporting by month. You're going to see they're going to want to know whether or not you made the minimum essential offer of coverage, the number of full-time applicable large employee members for employee count, and your total count for the applicable large employees. And then you're also going to see a section where you can fill in the information if you have 4980H transition relief. And so once again, that's simply if you are not required to offer in those months. So for a school district that has transition relief until October 1st of 2015, for the months leading up to 2015, you would be able to enter the code in showing that you had transition relief for those months and were not subject to any penalties in those months. So Form 1095C, this is going to be completed for any ACA full-time employee that was full-time in any one month of the calendar year. So once again, I want to stress that this is for anybody who breaches that 130-hour mark in any specific month throughout the calendar year. So the forms have to be provided to each employee and submitted to the IRS with the employer filing. So the indicator codes, so in order to make this simpler process, the IRS has come up with indicator codes. Once again, these are going to be things that you're going to have the ability to have populated, hopefully through the reports that are able to be run off the Crystal system. So you'll be able to have, for example, 1A is that a qualifying offer was made. 1H would be no qualifying offer was made. You've got safe harbor codes. These are the codes that would basically exempt you from penalties for each month that an ACA full-time employee is not offered coverage. So some examples of these would be a 2A, which is you were not a full-time employee during the month and you didn't enroll, or 2D, which is the employee is in that limited non-assessment period. So this would apply to substitute teachers, for example, that are in the measurement period. And we'll talk about this in a little bit, but if you're in that 12-month period where you're being measured and you're not eligible for coverage because you're being measured, then 2D would be the appropriate indicator code that would be filled out. That shows that even though the employee was over 130 hours and had worked more than 90 days for the employer, they were not eligible for coverage and there was no penalty that would be paid. And then 2I is the non-calendar year transition relief. And that just shows that in those months you were not required to comply with the mandatory offer of coverage because you were in that transition relief for your non-calendar year plan until the plan renewed in October. And for those school districts that have that, that would be January through September. And so this next slide, basically, once again, and I'm going to point this out every time we see this, is just these are drafts and they're subject to change. The IRS could definitely come out with different different forms and could make changes. But you'll see Part 2, we've got the offer of coverage, so you'd enter the required code on whether an offer of coverage is. Down in number 16 would be applicable section 4980 safe harbor, which would be where you'd enter that code for the transition relief if you have that. So determining the ACA full-time employees. This is something that is the Department of Labor and the IRS has went back and forth on, but there are two methods, and they're really pretty straightforward as far as how you determine who those Affordable Care Act full-time employees that have to be offered coverage. So the first is the most straightforward and the simplest, and that's the monthly measurement period. And that is really simply the first of the month following any month in which an employee that has been employed for more than 90 days breaches 130 hours of employment, they have to be offered minimum value coverage. So although this is straightforward, this is also incredibly problematic if you have substitute teachers or other variable hour employees that you're not sure how many hours they're going to work at the start of their employment, and they vary between below and above 130 hours any month, which is 30 hours per week. So as a solution to that, they created the look-back measurement method. And so the look-back measurement method allows you to look backwards up to 12 months for a variable hour employee. And I use the example of if you have a restaurant and you have a hostess that works 8 to 5 days a week, that's not a variable hour employee when you hire them. However, you have a line cook that's got to check their schedule every week, and some weeks they're below 30 hours and some weeks they're above 40 hours. They vary back and forth. That's a variable hour employee. And a substitute would definitely fall into this category. So for these types of employees, you can look back for a period up to 12 months, and you can measure the hours that they work, and they have to average over that measurement period 130 hours, which is 30 hours per week. If they do that over the measurement period, then you have an administrative period, which allows you to be able to process and determine whether or not they were eligible for an offer of coverage, make the offer of coverage, and have them accept it. Then there's a stability period, which generally speaking has to be the same length as the measurement period, where you cannot measure that employee anymore, and they have to be offered coverage. So this is a good solution because very few, even in the larger districts, actually have any employees or very many substitute teachers or variable hour employees that actually average 30 hours a week over the entire 12-month period. And just to be clear, you can't measure over periods of greater than 4 weeks where school is not in session. So during the summer months, you can't measure. So generally, we're looking at 40 to 42 weeks a measurement period. You can measure over Christmas break. You can measure over midwinter break, those types of things. So it's very difficult for a variable hour employee to average that 30-hour a week over that entire period. Really, if you take just a couple days a month where you're not going and working every day that's available, you'll fall below that 30 hours. So employers need to document the decision and establish procedures for administration of the new rules. So this is something that is going to be new for all school districts, and that's to have some type of a documentation of how you're going to apply these rules to which groups. So this is a sample policy for identifying full-time employees. So under Code 4980H, eligible employees under, it says XYZ Group Health Plan. So this basically says that for these employees, they're identifying full-time employees with respect to that 4980H, and for the purposes of identifying eligible employees, they're going to use the plan, let's see. So this is just like I said, this is just a sample of what would provide. You'll see if you look at the next slide, we have the election of the look-back measurement method. So this basically is where we would document that we're using the look-back measurement method as opposed to the monthly measurement method. And for our clients, we're going to be assisting with that, not only with making recommendations, but also providing the template language so that you'll be able to have that documented for your employees. So we're going to talk a little bit about the monthly measurement method. So basically, using the monthly measurement of the look-back method, you can choose between between employee groups and which one of these two methods you want to apply. So you can have different methods per group. So there are 4 different ways that you can determine methods. You can determine collectively bargained employees and non-collectively bargained employees. You can have different methods between each group of collectively bargained employees covered by a separate collective bargaining agreement. You can have salaried employees and you can have hourly employees, so it can be separate between those two. And lastly, you could have employees whose primary places of employment are in different states. I don't think D will probably apply to most of our school district clients. The one that I think could be problematic if it's not documented correctly is the salaried employees and hourly employees. So if you have non-represented hourly employees, and this would be payroll and benefits or admin people that are hourly employees, they're going to fall into the same class as your non-represented hourly substitutes. So if you have substitute teachers or other non-represented hourly employees, all of those have to be treated the same way. So we'd recommend that all of those employees have the look-back measurement method be applied. So once again, that does not mean that if you hire somebody at 17.5 hours a week, that's the hours that they're hired at, and you know the day that you hire them, that's what they're going to work, and that's enough to be qualified for benefits by that group. They can go directly onto the plan first of the month following date of hire or whatever your eligibility guidelines recommend. It is okay to then apply that look-back measurement period to the people that are hired that are variable in hours when you hire them. So that's something that's important to keep in mind. So just because you're applying that look-back measurement period to an entire class of employees, it does not mean that you can't offer coverage to those regular hourly employees that you know are going to work set hours when you do hire them. So with respect to recommendations on the initial measurement period for new hires, we'd recommend that the measurement period be 12 months. We're also going to recommend that there's a split administrative period. And so the reason for the split administrative period is simply that you can have up to 60 days to do the administrative period, and that's going to, the first part of the administrative period is going to be from the date of hire until the first of the following month. So if an employee is hired on May 20th, the administrative period, the first part of the administrative period would be May 20th through May 31st. What that does is gives you the ability to true everybody up so that you're now measuring on the first of the month. And no employer is then going to be required to make an offer of coverage or subject to penalties in the middle of the month, because carriers won't allow employees to go on in the middle of the month anyway. So that's simply the first half of the measurement period is just going to be between the date of hire and the first of the month following. Then we're going to measure for 12 months. Like I said, we're going to have to pull out those months where school is not in session. We're going to measure for 12 months. And then the next piece of the administrative period is going to be the 30 days between the end of the measurement period, the month following the end of the measurement period, 30 or 28 or 31 days. So that's the period where the district will have to calculate the hours, determine whether or not an employee breached that 130-hour per month average over that entire measurement period, make an offer of coverage to allow an employee to enroll in those plans, and then have the employee accept that and be eligible for and be enrolled in the plan. So we're recommending the standard measurement period, and this is for ongoing employees. So everybody is measured basically. If you have new hires, they're measured twice. They're measured initially from the date that they're hired. There's a 12-month measurement period. After you've made that initial determination, then they're going to fall onto the standard measurement period. And so a recommendation for the standard measurement period, and this is the ongoing 12-month period, and this is for non-transition relief, that would be from 11/1/13 through 10/31/14 for districts required to reply with the mandate by 1/1/15. So the recommended standard administrative period is 60 days, which would be, once again, for the districts that don't have transition relief, which would have went from 11/1/2014 through 12/31/2014. So you'd be able to make that offer of coverage for January 1st, and that would ensure that you're not subject to any penalties if you're making that offer of coverage. So one thing that I think is really important to point out about this is the use of the look-back measurement period is only available if you're making an offer of minimum value coverage at the end of the administrative period to employees who averaged 130 hours per month during the measurement period. So once again, to be clear, the IRS and the Department of Labor allows for the use of this look-back measurement period of up to 12 months only if employers are making an offer of minimum value coverage to employees that qualify as applicable large employee full-time employees under the Affordable Care Act, if they're making that offer of coverage to them. If you do not offer employees that breach that 130-hour average over that period coverage at the end, you cannot use the look-back measurement method. You'll have to use the monthly measurement method, and the downside to that is that you could be subject to a penalty of $250 per month for every employee that works greater than 130 hours in any month in which they work it if they weren't offered coverage. So even though you might only have 2 out of 200 substitute teachers that averaged 130 hours over that full measurement period, if you had 20 that were over 130 hours in any one month, you could be subject to that, to 20 times 250 or a $3,000, excuse me, a $5,000 penalty for that 1 month. So we're working currently with all of the carriers. I know we've got confirmations from Group Health and from MOTA and several others, but to make sure that they will allow for these variable hour employees that are deemed to be full-time to go on to the plan after the, if they're determined to be eligible at the end of the measurement period. So the one thing that I guess this really causes us to stress is that it's very important to do 2 things. One is to make sure that you have that offer of coverage. It doesn't have to be affordable and you don't have to fund it. You could still be subject to an individual penalty for that one employee, but it doesn't void your ability for all of the other employees. But the other thing is that tracking the number of employees that you have that are nearing that 30-hour per week average over that measurement period is very important. And we're going to talk in a little bit about how that tracking is done. So this slide just shows the standard measurement period as well as the new employee, and it assumes a hire date of May 20th, 2014. So you see that little date of hire, that first little piece is the administrative part of that goes from May 20th until the 1st of June. Then you're going to see that initial measurement period, which runs the next 12 months. Then you've got the initial admin period in between, and then you've got that stability period where that employee would have to be offered coverage if they were over that 30-hour average. After they have gone through that, or for existing employees, then they fall into the standard measurement period, which is listed above for everyone in the group. So for another thing that's got to be addressed that many districts have not addressed previously is a policy for determining when termination of employment has occurred for variable hour employees. So if we've got somebody, let's say, for example, that averages 130 hours per month over the entire measurement period, you make them an offer of coverage. For the most part, districts that we work with are using sub-online or a service similar where the substitutes simply call in and take work when they want to work, but they don't send the district notice if they're going to take off for, let's say, 60 or 90 days. So there needs to be something in place that states that in any month, for example, our recommended policy is any month in which an employee logs 0 hours, the employee would be terminated on the 1st of the month following and offered COBRA if they were enrolled in the plan. So this obviously excludes summer break, but this is simply to protect the district so that there's a concrete policy in place for determining when to term employees and when when an employee is no longer an employee. Because currently what happens in many districts is a substitute teacher could work 30 hours a week every week that was available and then take 2 or 3 months off, but would never notify anybody. They simply wouldn't call in and take any more work. So there needs to be some policy in place that's going to state when an employee is no longer an employee for the purposes of determining whether they're eligible for coverage and also whether they're eligible for COBRA. So support for tracking, for reporting and tracking for variable hour employee is also going to be provided through Northwest Regional Data Center through Crystal reports. So many of you, if you're our clients, we've already walked through these reports and looked at how to actually pull them so you can see on a monthly basis who's trending towards that 30-hour per week average or is above it. So the report's titled RET Hours for Multiple Earning Periods and can be found in the shared report directory in Citrix. And then it's got the actual location in there. So the required ACA reporting, so as I said a couple times earlier, NWRDC is developing a crystal report that will provide that data for the 1095-C reporting for the individuals and the filing to the IRS. We're really hoping that's out in early April 2015, and my guess is that they will try to have something out so people can walk through it, and if there aren't multiple workshops and breakouts at WASPO this year on this topic, I'd be very surprised. So this is actually a slide that shows the output of that NWRDC report for the multiple earning periods, and you'll see what it does is it's going to highlight every one of the months in which an employee breached that 130-hour average. So even if you look at, employees sued down at the bottom, and they had quite a few months. They had 142, 156, 137 hours. They only averaged 93.9 hours over that period. So as I said earlier, it's very difficult to average that 130 hours a month if you're taking even 1 or 2 days a month where you're not calling in accepting full-time work. The other thing to keep in mind, if you're a school district like Lake Stevens or Granite Falls, where you share a subpool, that's also going to make it harder for those employees to reach that 130-hour average. So if you're sharing a subpool with another district, if they call in for that other district, those hours don't count towards your 130-hour number and vice versa. So that's something that, should provide a little bit of relief. So as we've looked through this, even districts that thought they had a pretty high exposure, it's been really hard pressed. I think one of our larger districts had 2 employees when we looked at over the month of the previous 12 months going into January 1, and that was with thousands of employees that we were looking at. So it's very rare that we're going to see very many employees, but we want to be doing this correctly, and as I said earlier, we want to be making that offer of coverage so that we can use this method. Because if we were not using this method, the look-back method, then there would be a potential penalty for each one of these months that's highlighted. So if you ran that report and you're using the monthly look-back method, and you can't use the look-back method for 12 months, every time you saw something that was highlighted, that would be a potential $250 penalty if that employee had applied for and purchased coverage through the exchange and was eligible for a subsidy. So what we're recommending is then at the end of the measurement period, so any employee with gray highlighted months is going to be reviewed. So the total hours are simply going to be divided by the months in the measurement period, excluding the summer break, to determine if that employee averaged 30 hours a week or more over the measurement period. So alternatively, total hours worked could be divided by the number of weeks in the school year, excluding the summer break. So it comes out to be the same number. It really doesn't matter whether you impute the hours or not. It's going to end up being the same number when you just pull those hours over the summer period out. Oh, I skipped an extra slide. So offering coverage to variable hour employees who work 30 hours a week. So coverage when offered must be minimum value. As I said earlier, there are no plans that we are aware of that offer to school district employees that do not meet the bronze level 60% actuarial value coverage. That includes the high deductible health plans. Those are actually 70% plans, both through Primera, Moda, and Regions Blue Shield. So if coverage is not affordable, penalties may apply. So to ensure that avoidance of a penalty, the employee contribution for employee-only coverage can exceed 9% of W-2 income. So the $3,000 penalty, it is an annual penalty, but it's broken out by month, and so it would be each month that employee should have been offered coverage and was not offered coverage. So ACA full-time employees not offered coverage, or coverage is offered that's unaffordable, and the employee is enrolled with the state exchange, and the employee was eligible for and received the subsidy. So as you look at those number of employees, if you do have employees that you've made an offer of coverage to that you know is unaffordable because you don't have funding from the state and you simply allowed them to go onto your plan with no funding, the only way you will be subject to a penalty is if they have applied for, been approved for a subsidy, and enrolled in a plan and received a subsidy through the state-based exchange. if they've either applied for and been denied subsidy eligibility or have not chosen to accept and take the subsidy and the policy, there was no penalty. There'll be no penalty that would be for the school districts. So the next, we wanted to just take a look quickly. It's something that was brought to our attention about 2 months ago. And this is and I apologize, this isn't fitting the way we wanted it to on the screen. But this is a letter from the exchange, the Washington Health Benefits Exchange, to employers, letting them know that one of their employees has applied for health coverage through the Health Plan Finder and has been deemed eligible to receive an insurance premium tax credit. So the language that follows next is the thing that we have the biggest concern about, and that says this determination includes an assessment that your organization may not have offered minimum essential coverage to the employee, or the coverage may not be affordable. So we spent quite a bit of time on the phone with the Health Plan Finder, the Washington Health Benefits Exchange's legal team, talking about the language, because it gives a clear impression, and many of you have actually talked to us about these letters too, that there has been a determination that the employer could or is subject to a penalty. That's not what this means. So they're actually revising this letter that will be sent out, because all this currently means now is that one of your employees, or someone who claims to be one of your employees, has told the exchange that they make less than 400% of the federal poverty level and that they're an employee of your organization. And so that's all that they're taking in is employee attestation to determine whether or not they could be eligible for a subsidy. This is not a determination of whether or not you are eligible for it could be subject to a penalty. The penalties are going to be determined by the employer reporting that you submit. So once again, that employer reporting that we just went through, where you identify all of your 30-hour-a-week employees and you outline whether or not you offered them coverage and why you did or did not offer them coverage, that's going to be the information when it's matched up with people that have applied for and received a subsidy that's used to determine whether you're subject to a penalty. What this information is good for, what you may want to look at this more closely if you see that an employee was offered coverage on their initial eligibility date or open enrollment. So we've had many employers that have called us and said, you know, this employee is actually on our medical plan and we pay all their premiums. So if that's the case, that employee is going to have to, if they've received the subsidy, is going to have to pay back any premium tax credits, which could be huge, could be thousands and thousands of dollars when they file their tax return. And so most likely you want to let the employee know that they are not eligible for premium subsidy because they're on an employer-sponsored plan. The other thing that you want to look at is if the employee is offered coverage, or if the employee is not so if the employee is offered coverage in their initial enrollment date, or if they're not eligible for, or if they decline coverage when they have the opportunity. So they were eligible for it, they declined coverage, and now they're offering they're selecting coverage to the exchange. You may want to reach out to that employee and let them know that they could have to pay these back. So no action is required. So if the employee is not offered coverage due to either being in the measurement period or is not an ACA full-time employee, or in many cases people have just said that they're an employee of Boeing, for example, and they either are no longer or have never been an employee, there's no need for you to respond. So you do not have to respond if that's the case. So what's next? And just one last thing. If you do want to respond, so if an employee is saying that they're eligible, there's a telephonic hearing process, and that's on page 2 of the letter that you'll receive. And it doesn't sound like it's a complicated process, but it is something that you'll need to do. You'll need to call in, and there's a hearing that takes place where they determine whether or not that employee is actually eligible for the subsidy or not. So in most cases, it's not something that you need to get involved in, especially if the employee is not eligible because they're part-time. So once again, they're not doing a vetting process. There's no determination of whether or not they were actually offered coverage, whether they're a full-time employee, or any of that stuff is occurring. They're simply sending you a letter saying someone claims to be an employee and was not offered coverage, and so they're eligible for a subsidy through the exchange. It's all on employee attestation. So what's next? So as we've already said, every person on this call really can avoid and skip the first one, which is making your applicable large employer determination. All of the school districts on this call are applicable large employers. You want to determine your Affordable Care Act strategy to limit and ensure compliance under the law. So that's simply outlining what your strategy is going to be with respect to the look-back period to make sure that you have the ability to make that offer of coverage to those who exceed that 30-hour-a-week average, and that you're actually tracking and doing that. And so this, for those school districts that have transition relief, this next 6-8 months is a really good opportunity to be able to begin doing that tracking. Make sure you have the ability to track who is and who is not an ACA full-time employee. So we want to select and document your process for identifying those full-time employees. So really we want to have something that's memorialized to say this is the process we're using for each class of employees and how we're determining whether or not they're full-time employees. You need to determine who in your organization is going to be responsible for the reporting. So generally that's going to be somebody that has the payroll and benefits function. So in some of our smaller district clients, that could be the business manager, director of finance. Some of the larger clients, there may be a team of 3 or 4 separated by bargaining entity that handle it. But it does need to be clearly identified on who's going to be responsible for doing the reporting. So we need to be able to understand the reporting solution available through your payroll and benefits vendors. Unfortunately, that's not something we can do right now. We do need to have those reports available to us. And for most of you, those will be crystal reports through the NWRDC or the WSIPC system. And we need to ensure that you're tracking the necessary data that will be required next year. So that's one of the things, once those reports are available, is we're going to need to go through and make sure that all of the information, all of those separate codes, all the places where we need to have an identifier, that we're actually tracking all that information. And that's something I think will be a fine-tuning process through payroll, because one of the things that's been brought to our attention is some of you feel that the payroll doesn't have the necessary information to be able to provide comprehensive reports. And so we're going to have to really monitor closely what those are, that each one of those sections is being tracked. And lastly, we're going to engage your trusted partners for assistance. And so that includes the partners group. If you're not working with us, that should be whoever your consultant is for employee benefits, as well as your accountant or your attorneys. We have attorneys that are available for our clients that we use to make sure that all of our clients are going to be compliant, so that they make sure that they're also not only having the ability to meet the requirements of the Affordable Care Act, but that there's no surprises. There are no penalties that they weren't planning to be exposed to that they're exposed to. And so that's the conclusion of our presentation today. Thank you to everybody for calling in. So the one question that we had was, one of the questions we had is, can we report on employees under 130 hours, and would we want to? So there's no place that we've seen in the forms that would allow for reporting employees under 130 hours, nor would I think it would be in anyone's interest to do so. So there's nothing that the IRS has given us that has indicated that would be acceptable, or that they would want to see that information. And so if you want to send follow-up questions, you can send follow-up questions to Jennifer Spencer in our office. Her email address is jspencer@tpgrp.com. And so by the end of the week, we'll be sending out a complete slide deck to everyone who's enrolled and participated in the seminar, as well as a comprehensive list of any questions that we've received related to the webinar. So with that said, I want to thank everybody for calling in and participating in the webinar today. We look forward to talking to you soon about what your options and responsibilities are under the Affordable Care Act. Thanks so much.